Let's start with this market pricing here, because we are, of course, talking about somewhere between 5 and 6 Fed cuts being priced into 2024. But I'm curious about the vehicle with which that's being used. For example, are we talking more about the Federal Reserve indicating some sort of dovish tilt, a pivot, if you will, or is the market really in control here, just given the massive amount of supply that's on the front end of the curve? Is the market in control of this pricing more than the Fed is?
Yeah, thank you for having me. Really appreciate it. And I think that actually the market is more in control of what's going on with the pricing. And we have to keep in mind that Fed funds futures market, even overnight index swaps, especially this time of year, it's really being used for a variety of reasons, not just for the purpose of making bets on what the Fed is going to do. That does factor into it. But if the market is pricing in, let's say, 6 rate cuts next year, probably starting in March, the Fed might want to be a little bit slower just to show that the market is not dictating the Fed, that the Fed is still in control, even though for the most part, the Fed is going to follow the lead of the markets here. So maybe the truth is somewhat in between as far as 6 versus 3. Maybe it's going to be something closer to 4 cuts next year instead.
Brian, I feel very validated about talking about the market simply being in control. Let's kind of lean into that narrative, though. When we're talking about credibility for the Federal Reserve, we know this was a major issue as we talked about how they're going to really be tackling inflation. One of the key pieces that Chair Powell was really worried about in terms of kind of really pulling us back down to a 2% inflation target was whether or not those cuts, whether or not that pause was going to come too early, some sort of Volcker repeat. Brian, is that still a threat?
I don't think so. I don't think we're going to get another wave of inflation. And so I think the real discussion now with the Fed is how long that pause should be, and then when and why they should start pivoting towards cuts. So that'll be a key thing to really listen to for some of the messaging, is whether or not they're trying to do some recalibration or fine tuning of policy, focusing more on the real rate as opposed to the nominal rate. So I think that Waller and even Powell, to an extent, has already kind of laid the groundwork for the justification of rate cuts just to track inflation moving lower. So if that 3-month annualized moving average of inflation is moving lower, the Fed is probably going to take that as an all clear signal in order to start cutting. Now, if they are focusing on this backward looking data, the risk is that they're going to be slow in cutting rates. And so as a result, inadvertently, they will start tightening monetary policy just by trying to follow this backward looking data. So in a way, they could almost really kind of seize victory from the, or they could seize defeat from the jaws of victory here.
That's a very cinematic term, I have to say. Brian, talk to us then about some of the commentary that's been coming from around the world. And bear with me here as we talk about Governor Ueda, for example, over at the BOJ, Christine Lagarde over at the ECB, Andrew Bailey at the BOE, and of course, Chair Powell. All of them have said that some of the sell-offs that you saw in treasuries in particular earlier this year has had an effect on the economies, not on the markets, but on the economies directly, because it was a sustained sell-off in the long end of the curve. Brian, does it work in the opposite direction? If we see this bond market momentum become more sustained, does that do the work of a rate cut for the Federal Reserve?
It really does. And we've actually looked at that on our investment committee here at Annex, is looking at the structure of debt for a lot of companies. So for individual companies, it can have a bit of a cliff effect as far as, do you need to refinance at these higher rates? If it suddenly goes from 3% that you were sitting on, have to refinance at something closer to 8%, that's a big move. Now, for the market as a whole, you really have to kind of take this more as a slope as opposed to a cliff. It's not necessarily a maturity wall, because companies are going to be able to refinance at various terms and at various times, maybe use a little bit more equity, offer a few more incentives to lower that rate as far as like convertibles, things like that. But it will likely have an effect now that we've seen rates move lower. I know a lot of home builders and home sellers are pretty excited about seeing that 30-year fixed rate mortgage go from having an 8 handle on it to a 6 handle. So it's still not back to maybe a 3 or a 4 where they were just about a year or 2 years ago, but it's at least a little bit better. So on the margin, it is likely going to help. And I think that's why a lot of people are getting more excited about a soft landing. But the key thing is the Fed going to really be able to stick the soft landing? And that's where if they're kind of slow to adjust or recalibrate rates, it could become more of a bumpy landing instead.
But you're talking about a lot about the refinancing that a lot of corporate America might actually be able to do, and that's all fair. But if you're doing it in the context of, say, higher price hikes, for example, that's one of the concerns that a lot of regulatory authorities around the world are looking at corporations saying, well, inflation is coming down, but your prices are still sticky. Is that warranting then some of the services and goods that you're offering the consumer? Brian, can the consumer handle that repricing?
Yeah, now thankfully, we know the unemployment rate is low. Also, wages on a nominal basis are growing at about 4.5%. So if inflation is 3.5%, real wages are at least growing. They're at least positive. And so that is a nice change where consumers are likely able to weather those somewhat higher, stickier prices. And that's a really important distinction that you make here, is the difference between inflation and the price level. Lower inflation doesn't require lower prices. It just requires prices to stop rising so quickly. But consumers think about it more in terms of that price level. And so some of the pushback, lower inflation doesn't mean that corporations, that their costs have actually declined. It's just that they have stopped rising as fast as what they have. So there is a bit of maybe political messaging going on as far as with twisting some words about inflation versus price levels.